Welcome to Petros Family Wealth. Today we're going to talk about 3 different types of structured products. The 3 different types of structured products we're going to cover today is 1, principal protected note, 2, a yield or income note, and 3, a growth note. But before we dive in, I do want to share that these are all hypotheticals and not a specific example or a recommendation for you and your family. This is purely meant to be an educational series to arm you, educate you, for you and your family to become better investors if you decide to incorporate structured notes. So with that out of the way, let's go ahead and dive into some examples. So the first one I want to cover is a principal protected note. This type of downside can be incorporated in an income or a growth-oriented note. But a principal protected note, there's 2 different types. One is based on the full faith and credit of the issuer. So for example, if we lend money to a bank and have a number of characteristics associated with it, even if the underlier is down significantly, as long as the issuer, the bank, is able to pay their debts on their bonds, then the client will get their full principal back. The higher level of principal protection is incorporating FDIC insurance. And you can add those to your principal protected notes, so that even if a bank were to become a failure and go into bankruptcy, it's backed by the Federal Deposit Insurance Corporation, similar to a traditional certificate of deposit. These can be tied with either income or growth, but I'm going to show an example or hypothetical here of a growth-oriented note using principal protection. So in this example, this one is a 5-year structured note where it's based on the S&P 500. And this one has the full issuer protection, not FDIC insurance, so we are still susceptible to bankruptcy risk of the bank that we choose. But this one has a 1-for-1 upside on the S&P 500, but capped at a 75% return. So let's just go through a couple of examples. Let's say we bought this, put $1,000 in. 5 years from now, if the stock market's up 50%, well then the client will get a 50% return. If the stock market did really well and is up 100%, well then they're capped at a 75% return in this participation. But one of the main features that you want to look at is in the downside protection. So let's say the S&P 500 is down 30% 5 years from now. Again, so long as the bank is still paying their debts, the client would get all their principal back. So this might be a good fit for clients that feel the need to participate in the stock market and the equities, but don't want to experience that full downside participation of a traditional equity investment. The second one I want to cover with you today is an income or yield note that produces generally quarterly, sometimes monthly coupons to generate some additional income above and beyond a traditional fixed income portfolio. And the type of investor that invests in these generally have it right in between a regular stock and bond, in that there are some fixed income risks as well as some equity risks. But in the example that I'll show you here a little bit, it actually sometimes can be very fruitful if the stock market is down to help generate some additional income. But the way these work is they're generally based off of 2 or 3 stock market indices, and there's quarterly snapshots. So every 3 months there's a snapshot, and as long as one of those stock market indices is down, but not down, let's say 25% from when we purchased it, well then a coupon is paid to the client in cash. So again, this would be for folks that want to have a little bit of a diversifier between stocks and bonds, where they're generating some additional cash flow if we're experiencing some choppy markets. So in this hypothetical, a client that might buy this, they have, again, a couple different indices, stock market indices. And this one might be NASDAQ, which is more large cap technology-oriented companies. Russell 2000, which is more of a smaller U.S. company index. And then the S&P 500, the 500 largest U.S. companies, publicly traded companies in the U.S. And the way this one works is potentially up to 4 years where we can hold this, but I'll cover in a moment where we might get our principal back early. Again, after we purchase this, every 3 months there's a snapshot. And so long as one of them is down, one of these indices is down, and not down more than 25% from when we purchased it, well then a coupon is paid to the client in cash. In this hypothetical, a 10.25% per year, so a little bit over 2.5%. It's paid to the client in cash. Now, let's say on one of those quarterly snapshots that all three of those stock market indices are positive, which is generally the case over time. Then what will happen is that coupon for that quarter will be paid, but then the client will get their principal back early. So it is likely and often where the principal is received earlier than that 4 years. But where these typically shine is if there's a rough patch in the market for multiple years, where at least one of those indices is down, again, but not down 25%, then the client will keep getting those coupons paid to them and keep getting that cash flow. However, let's say, for example, one of those indices is down 30% from when we purchased it on one of those snapshots. Well, the client's going to miss out on that coupon. There might be multiple points where we miss out on those coupons. But at the end of the term, so at the end of the 4 years, whether they got the coupons or not, there's at the end of that 4th year, if all three of these stock market indices are either positive or not down more than 25% from when we purchased it 4 years ago, then the client would get all their principal back. And their total return would be the full amount of coupons that they've earned over the years. The problem is on the downside is, let's say, for example, one of the indices is down 30% at the end of that 4 years. Well, this is a barrier protection, which is like a cliff protection or sock protection, where if the underlier is down 30% at the end of the 4 years, well, the client is down 1-for-1, down that 30% on their principal, and then you subtract out whatever the coupons that they earned to identify what their total return is. So that one is generally right in between stocks and bonds, trying to generate some additional income, particularly in 2022 and 2023, where stock and bond correlations, or how they move, were generally pretty tight. They kind of tended to move together. And so this is one of those diversifiers that may help in those types of situations. The last one I want to cover is a growth note. And the growth note, this one we want the stock market or the underlying indices to be positive because we're trying to get some upside or outside participation on those underliers. And so the example I'm going to show you here is based on the S&P 500 and a mid-cap stock index for the US. And the way this one in the hypothetical works here is be for a 3-year investment. So you buy it today. It doesn't really matter what happens in between the beginning and the end, but at the end of that 3 years, whichever one did the worst, the client will get 1.4 times the upside. So, for example, over a 3-year period, let's say the S&P and mid-cap, the worst performer is up 10%. Well, the client will get a 14% return. And there's no cap on this one because the downside protection is what's called a hard buffer, or 10% hard buffer. So the client invests in this 3 years from now. Let's say the worst performer is down 15%. Well, then the client will be down 5 because this one ate the first 10% loss. And so generally you want both of these stock market indices, you want to be positive on both of these indices as you're trying to get that upside participation and try to out-earn that particular index given that upside, that leverage upside, and some downside protection, not quite to the extent of that principal protection or the FDIC insurance. And so therefore, this is typically more suitable for folks that are more growth oriented. So I hope you found that helpful. Those are the 3 different types of structured products: principal protected notes, income notes or yield notes, and growth notes. And if you found it helpful, please go ahead and like, subscribe, and hit that notification button. Thank you so much.